Welcome to the Fear and Greed Daily Interview. I'm Jennifer Duke. Regular listeners to the podcast would know Sean Elmer frequently speaks to Matthew Kidman about equities, about what he's watching, what he likes, what he doesn't like. And now that we're into reporting season, it seems like a pretty good time to chat to Matthew about the trends he's seeing and the companies he's keeping an eye on. Matthew Kidman is principal at Centennial Asset Management. This information is general in nature and you should seek professional advice before making any investment decisions. But Matthew, welcome back to Fear and Greed.
Hi, Jennifer. How are you?
I'm good. Thank you very much for coming on and speaking with me in Sean's absence.
That's all right.
Let's talk a little bit about last week before we get onto the companies yet still to report. So CommBank is one of the only big banks reporting this season. What did you make of their results?
Yeah, the result was, look, expectations weren't high because, as we know, we've got a slowing housing and mortgage market. We've all talked about the mortgage cliff. And one of the things that's hurt the banks in recent times has been what we classify as their NIM, their net interest margin. And they used to make more on each loan years ago than they do today. So the overall NIM for the whole of their book had been coming down, and people were worried about that. CommBank delivered a pretty good result. The NIM held up, and even though the outlook wasn't rosy, they said it was getting tougher. The numbers were good. It was probably slightly better than what everyone thought, and that was good enough for the market. They bought that. So that was a good way for the overall reporting season to kick off with one of the stocks that people were worried about actually getting off to a solid, I wouldn't say brilliant start, but solid start.
There was a little bit of talk about a tycoon tax, if I'm not mistaken, about potentially leveraging that on some of the banks after I think they did so in Italy. Do you have any thoughts on whether or not that's appropriate, given those NIMs?
Look, I think it's a much longer discussion and one worth having at some stage. Since the global financial crisis, regulation around the banking system has tightened considerably, which was very necessary at the time, as we know, because things got out of hand and it turned into a disaster. But slowly but surely, banks have almost become government bodies around the world. And we saw that again when we had the COVID crisis. The banks were reined in by the government. I think we've got to get back and get a bit more balance, and the Italians have just gone too far in that sense. We need a good system, we need good regulation, but we need banks to be able to run their own businesses free of the burden or extra burden that governments have started to levy on them. So I'm against the Italian move, and I don't think we should go down that path. And that said, APRA does a terrific job here, but we need a little bit of freedom for the banks and their teams to actually go to work and help the economy grow.
That's a very nice measured perspective. So James Hardie started off last week with a very big bang, and investors responded well when the building materials company said it was able to expand profit margins. Was it an outlier, do you think, being able to push up prices like that?
Oh, they've done a terrific job. James Hardie, although an Australian company with a long history here, has the bulk of its business in the US, and it's obviously a very big market, and they're growing into the US and gaining market share. One of their competitors reported a week or so earlier, and there was a bit of discounting. Margins were down. People were worried. James Hardie came out and did the opposite. They were able to increase their margins. Volumes, while have slowed, like everywhere else around the world with interest rates going up, but nowhere near as much as people thought. The upgrades from analysts were 10, 15, 20% to valuation. It was a report for the ages in terms of being able to do, pricing power, protect margins, protect volumes in a tough market. So it was a great result. And I think the response was deserving.
Stay with me, Matthew. We'll be back in a minute. My guest this morning is Matthew Kidman, principal at Centennial Asset Management. And was there anything else that you particularly liked last week?
Well, sticking with the building materials, Boral, who they've sold their US operations and they mainly operate here in Australia and mainly in the cement market, they were also able to generate price increases and surprise the market with their margins in a pretty tough market, as we know, as building slows down with a higher interest rate. So that what we all looked for when interest rates started to go up a year or so ago was who could put their prices up and who could get away with it and had enough market power to do that. It seems like companies that weren't expected to be able to do it. Some of them have been, and I put Boral into that camp, and maybe even James Hardie. So there's two nice surprises. And otherwise, most of the businesses that have come out so far, and we've had a few of the insurance players, we've had QBE, and we've had some smaller players like Credit Corp. Once we get below that top tier, though, it's a little bit mixed. But next week we will see a lot more companies reporting in number, maybe not the size of CBA, but the amount of companies reporting, and we'll get a bit better idea. Just to finish off on one that reported on Friday, which was Nick Scali, which most people would know, quite a well-known brand name in the retail furniture area.
Yes.
They came out with a result that was very strong, and surprisingly so as the consumer, with the mortgage cliff supposedly under pressure. They beat the market, and even though July was down, it wasn't as down as much as what people expected, and it's up double digits. So there have been some nice surprises in the first week, but we'll get a better idea next week when we've probably got 3 times the amount of companies reporting.
So we're all still out there buying couches and decking out our living rooms, is that?
You wouldn't think so. You would have thought we'd bought enough, but it seems to be the case. It seems to be the case.
So it sounds like a big week is coming up ahead. What are you watching in particular?
There's lots of companies reporting. There's a number of retailers again. So a lot of the discretionary retailers have had a kick along today on the back of Nick Scali, but we've got players like JB Hi-Fi reporting next week, which is always a bellwether for the general consumer. It's electronics, and we bought a lot of electronics during COVID as well. So it'll be interesting to see what they do. We've got a whole bunch of different companies. We've had REA, realestate.com. It was another one out last week on Friday. It put out a sound set of numbers, but next week we'll have Seek and we'll have Car Sales, those big platforms that are consumers. So there's a lot to look out for in terms of the consumer, because that's the part of the economy, which is about 60% of our economy, which is now in slowdown mode because the Reserve Bank deliberately is trying to slow down the economy. So that will be the key next week. Who can do a Nick Scali and who can push their way through. On top of that, as I said, there's a lot of companies. We're getting reports from people like the Seven Network, which is a media company, and that'll be interesting just to see how advertising's going. All reports are that advertising is very short, as they say in the industry. In other words, people aren't booking in for too long because of that slowdown. So the general feel is everyone's just a little bit tense about where we are in the cycle, and numbers expected to be bad. So if we do get numbers like we have this week, like a Nick Scali or a CBA, where they're not quite as bad as what people think, I think you can expect a rally in the share prices like we've seen in the first week.
That's really interesting, because I also think, the Dr. Lowe was up in front of Parliament recently and was talking about the lag effect of those interest rates on sort of the public, on mortgages and all the rest. Do you think maybe these results are a little bit too early to be taking into account some of that shift?
I think the move in interest rates haven't been as quick as previous cycles. Now, we're not sure why. I suspect there's some offsetting factors. For example, the consumer got a lot of money from governments during COVID and saved a lot of that money, and so there was a buffer that maybe wasn't there previously. And of course, the overall economy is being helped along now by pretty strong immigration numbers. So people are coming into the country. So there's some offsetting things, but against that is higher costs, especially around your mortgage. And I think we're just at the front edge. I don't think it's going to be as bad as what we would have anticipated, and that's one of the great revelations over the last 3 or 4 months, is that the consumer's more resilient. It's not going to be as bad as inflation comes down. But I think the turning point probably came after Easter, maybe May into June, where things softened. We got an update from Myer. It wasn't their full set of accounts last week, just an update on where they're at. And it became pretty obvious that the last 6 to 8 weeks has got a lot tougher. So we're at the front edge, and we will see a bit of it in the commentary about how the new year started, maybe not in the numbers reported because they're to the end of June, but we'll definitely see it in the commentary about July and August. And probably the worst of it, or possibly the worst, will be AGM season, which is October, November, when we would have had a noticeable slowdown in where things are going. A smaller retailer that came out at the end of Friday last week was Baby Bunting. We already knew their numbers, but what we didn't know before that was how the new year had started, the post-financial year, July. and they're reporting that they're down 9% on sales. So I think it's starting to get traction in a meaningful way.
Is that fewer people having babies in COVID?
Yeah, I don't think that's helping. They've got a structural issue there as well, and birth rates are down. So that with someone who's the dominant player in that industry, and they start to require the industry to itself grow, not just getting market share, because they are the dominant players. They need the industry to be buoyant, and unfortunately, birth rates are down for the country, which is not always good.
And so, are there any sectors that might offer a few surprises next week?
Look, I think if we stick with the consumer is an important thing. It's not only discretionary retail; it's a whole bunch of different areas, including car sales, home sales, and home renovations. So I'd be looking out mainly for those areas. And as I said, I think also we'll get some insights into media with Seven coming out. I think that'll be good. We've got other players in the online game, Temple and Webster. We had Satire, which is the luxury goods online site that did really well. I think that's what we need for the share market to go higher. We had a rally through June and July, and then it's come off a bit in August. But I think if that rally is to spread and we're back into a bull market, the market through these results have to look through this bit of a valley of earnings because, as I said, financial conditions are tightening. If they can do that through this period, and companies have shown that they can handle this period by putting prices up and keeping a lid on costs, I think it will be a platform for the market to go higher in the back end of the year.
Thank you very much, Matthew. That was fascinating. And thank you for talking to Fear and Greed.
Thanks very much.
That was Matthew Kidman, Principal at Centennial Asset Management. This is the Fear and Greed Daily Interview. Remember, this information is general in nature, and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Jennifer Duke, economics correspondent for Capital Brief and filling in for Sean Elmer. Have a great day.